Hey everyone, and welcome to this explainer. You're tuning into the Agile Auditor at Risk Vigilant PARETH, and today we've got an absolutely fascinating breakdown lined up for you. We're going to unravel a high-stakes financial classification that honestly trips up professionals all the time. Now, it might sound like simple corporate jargon, but getting this wrong, it can literally destroy a company's financial reporting overnight. We're looking at Capex versus Opex purchase orders, and more importantly, how blurring the lines between them creates the ultimate auditor's nightmare, the budget smuggler. Okay, let's dive right into this. Picture this scenario for a second. A company just enthusiastically dropped 2 crores on cutting-edge new factory robots, right? This is a massive, incredibly positive upgrade for the business. But a confused buyer over in the procurement department makes a single keystroke error, and they accidentally issue the purchase order for these robots under daily operational expenses. Boom. Instantly, that one tiny classification mistake triggers an absolute disaster. The company's monthly profit statement is completely wiped out on paper. It literally looks like the business just took a massive, fatal loss for the month. It's the kind of mistake that can tank stock prices, freeze budgets, and send the CFO into a heart-pounding panic. And why did this happen? It wasn't the purchase itself. It was because the buyer fundamentally did not understand the severe financial difference between a Capex and an Opex PO. All right, let's lower the tension for just a second and get our definitions straight. In really simple words, a Capex, or Capital Expenditure, PO, is used to buy long-term assets. These are major investments that bring real value to the company for years to come. So when you're buying land, heavy factory machines, or even, a fleet of company laptops, you use a Capex PO. You're buying something that's going to stick around for a while. Now, on the exact opposite side of the spectrum, we have Opex, or Operational Expenditure. An Opex PO is used to buy short-term, day-to-day items or services. These are things that get consumed immediately, literally just to keep the lights on and the business running. We're talking about printer ink, the monthly electricity bill, or minor routine equipment repairs. Think of it like this. It's a brilliant, everyday analogy. Buying a car, that's a Capex purchase. You pay a big chunk of money up front, sure, but you now own a physical asset that you're going to drive for the next 10 years. But putting petrol in that car, that's an Opex purchase. You pay a small amount today, but that fuel is burned and completely gone by the end of the week. The car is the asset, the petrol is the operation. Section 1, the XYZ Limited Factory Upgrade. Let's look at a real workplace example. Meet Raya. She's a project manager in charge of upgrading the factory at XYZ Limited. On day 1, Raya needs to secure a reliable power supply, so she issues a Capex PO for 50 lakh rupees to buy a massive new backup power generator. Now, because this generator is an asset that's going to last for 10 years, the finance team does not deduct that full 50 lakhs from this month's profit. Instead, they slowly deduct its cost over a decade, which is a process known as depreciation. But fast forward to day 7, Ryan needs to test the machine, so she issues an Opex PO for 1 lakh rupees to buy diesel fuel to run that generator. Because the fuel is burned and consumed right away, the finance team deducts that entire 1 lakh expense directly from this month's profit. So here's your ultimate confusion buster, because beginners constantly mix up what they're buying with how it actually affects taxes and profits. Let's look at the financial impact. Capex POs hit the balance sheet. The strict rule here is that the cost is spread out over many years, meaning it doesn't destroy today's profit margin. Opex POs, however, hit the profit and loss statement, or P&L. The rule for Opex is that the cost is absorbed entirely right now, which instantly lowers this month's taxable profit. But what happens when people try to actually game these exact rules? How might someone try to exploit this system to get what they want? Well, this brings us to the ultimate auditor's red flag. We call this individual the budget smuggler. Here's exactly how a budget smuggler operates. Imagine a department head who has completely exhausted their annual Capex budget. It's gone, but they desperately want to buy a new 10 lakh rupee server for their team. If they submit a Capex PO, the CFO is going to immediately reject it because, well, the budget is empty. So, to bypass the CFO's rejection, the manager colludes with the vendor. They take that 10 lakh server cost, split it into 12 smaller invoices, and falsely label them as monthly IT maintenance. Guys, they are secretly smuggling a long-term asset into the company disguised as an everyday operational expense. And listen, this is exactly why audit teams have to be so incredibly vigilant. Auditors use automated data analytics to rigorously scan Opex accounts, specifically looking for these exact patterns. Suspiciously high recurring invoices that just look a little too uniform. They're actively hunting for managers who are trying to hide unauthorized asset purchases in plain sight. You might think you're pretty clever dodging the Capex approval process, but an Agile auditor, they're going to spot those fake maintenance invoices from a mile away. All right, let's lock all of this in. I want you to remember this super simple recap framework. Capex builds assets. Opex runs the business. I'll say it again. If you're building for the future, you're making a capital expenditure. If you're just keeping the lights on today, you're making an operational expenditure. Which leaves us with one final, pretty important question to end this explainer. I want you to think about your own procurement data. Check your department's OPEX accounts this week. Are you absolutely sure everything in there is truly an operational expense? Or are you, maybe accidentally, acting as a budget smuggler yourself? Take a really close look at those invoices. You might be surprised by what you find hiding in your P&L. Keep your eyes open, stay vigilant, and we'll catch you on the next explainer.